Welcome back. You're still tuned into MF Corner on CNBC-TV18, where we talk about mutual funds. But one category that the AMFI website now also talks about is SIFs. And that is an interesting one that came in with effect from 1st April of 2025, which was a new category which was introduced by SEBI, where a minimum threshold of 10 lakh, that's a minimum investment amount that is to be made by an individual. It is to bridge the gap between mutual funds and PMS, or portfolio management services. It allows for long-short strategies. There'll be sectoral rotations, dynamic asset allocations, offering greater portfolio flexibility. So it's basically somewhere in the middle of PMS and mutual funds as well. As per the data today that we got, the total AUM of SIF stands at 5,729 crore rupees. So it's still in the nascent stage, but we do have some of them which have been launched already. There's Edelweiss AMC, which has launched the Altiva SIF. Bandhan AMC has done it with Arudha. Divinity from ITI AMC. There's iSIF from ICICI Pru, Magnum from SBI MF, Titanium from Tata AMC, QSIF from Quant MF, and now we have Dyna SIF, which will be launched by 361 and asset management. And of course, this is an interesting category, still, as I said, in the nascent state. So it'll be good to understand more about the nuances, who it is suitable for, what kind of risks would be involved, and a lot more.
Absolutely, and to discuss all of that, we have Raghav Iyengar, CEO of 361 Asset Management, joining us right now to talk to us about that. Thank you so much, Raghav, for joining us this afternoon. Let's just start by talking about the basics. Why should an investor consider SIFs instead of mutual funds or PMS?
Superb question. You always start off with the bouncers, right? I think the interesting thing about this category is that it's actually at the intersection of mutual funds and maybe alternate investments or PMS. So you have the simplicity, the taxation, the transparency of mutual funds. And of course, you have innovation in the form of derivatives usage which is typically given to very, very high net worth individuals, typically investing in AIFs and PMS. That intersection has actually come together and created this lovely category called Specialized Investment Funds. So actually, it's a fairly path-breaking category. Typically, you can really make money in some interesting situations here. Potentially there is ability to make money even when the markets are falling through use of some innovative derivative strategies, which frankly you cannot do in the MF segment as per regulation. So I think it's a fabulous category. In fact, I was just listening to the monthly flows, and I think at some point of time, this category will also surprise you and will be a very, very larger part of the overall AUM of investors.
Okay, all right. So in that case, let's understand more about this, Raghav. How does the long-short SIF help manage risk versus, say, a regular equity fund?
Yeah, so typically, I think there are three ways, right? I think the biggest thing is that you can do some level of downside protection, as I said, using some amount of derivatives. The regulation allows the scheme to go 25% short, which means basically that if I feel that, or if the fund management team feels that there is a sector which is overvalued, or stocks are possibly out of their earning cycle, there is a potential way to make money when the stocks are actually reducing in value. Typically in long-only funds, you typically stay out of these stocks, or at best you buy, sell in cash. Now let's look at a sideways market, which, say, for example, happened last year in 2025. You all know returns were fairly flattish. I think there you can create some earning capability by doing, again, derivatives, by taking some long short positions, by taking some index futures, taking some index arbitrage, and adding to some amount of the portfolio return. But the core of this business, again, is the fact that you will make the bulk of the return will come from long only strategies, because the way these structures are, these products are structured, is that you have to be let's say in the equity long short category, you have to be 80%, minimum 80% long, and up to 25% short. So this just adds on to potential returns, basically. So,
Raghav, which SIF category should investors actually look at now?
That's back to basics question, Vinnii, because I think, there are three categories largely here, like mutual funds. There's an equity category, there's a hybrid, and there's also fixed income or debt category, right? I think most of the launches have happened around hybrid and a few in equity. But really, it's up to the investors' risk appetite, time horizon. And, there are in mutual funds, different categories, different strokes for different folks. The same logic applies here in SIFs too. So let's say if I am a risk averse or a conservative investor, I have the option of looking at investment into hybrid categories. And there, again, there are two categories: there's the equity hybrid long short, and of course, there's the asset allocator, which both of them are similar to, let's say, multi-asset funds and hybrid funds today. So in that sense, there is an ability to marry your risk appetite, your investment horizon to the products offered. There are 7 subcategories, as you know. There are 3 in equity, there are 2 in fixed income, and there are 2 in hybrid. So the important thing is to try and figure out what the product is doing for you. Does it fall into the high risk category? The same riskometer applies here. So if you go to any scheme offer document, you will see the same risk bands 1 to 5. Marry your risk, marry your investment appetite, marry your time horizon, and yes, hopefully enjoy the journey.
Okay, so we'll keep asking a lot more basic questions because as you also said, it's a nascent category or an asset class, and you expect it to grow. So it's very important to understand those nitty-gritties as well. So say somebody already has investments in mutual funds where you don't need a 10 lakh corpus, right? You can do it with as much as 5,000 or 100 or 200 as your monthly SIPs. But here you have to put out a big amount of corpus. So at what level of investment journey should investors look at SIFs in their portfolio? It wouldn't be for a first-time investor, right? So how do you take so many factors together to understand whether SIFs are right for you? Of course, the subcategories come in later, but this is the product for you. How do you make sure of that?
I think critically, let's do it the reverse way. So let's try and figure out who this is not for. So obviously, it's definitely not for somebody who's coming into capital markets or mutual funds for the first time. Irrespective of all the marketing and all the jargon, I think very clearly it's definitely not for somebody. Somebody who's already got a core mutual fund portfolio is looking to diversify beyond traditional mutual fund investments. I think that's the place to go to. Obviously, because it's a 10 lakh rupee minimum, it is catering to a slightly more evolved, educated audience, people who've already got hopefully money at play in capital markets. And then obviously it's in that sense, obviously then you get into the relevant product categories, look at the risk meter, and then figure out whether that really meets your time horizon. So let's say if you're in an equity long short, typically the risk band will be 5. I mean, that's the highest risk band. So ideally, very, very sophisticated investors, possible chance of capital diminution. So hence you have to give that time horizon of at least maybe 3 years, 5 years plus, and be prepared for times when the portfolio doesn't do anything for you.
Okay, and what about costs in general? How does the costing work here for an investor versus say a mutual fund?
It is pretty much identical, so there's no difference. That's the beauty of this product, because you've basically taken all the good things of mutual funds, which is the transparency, the regulation, the cost structure, the portfolio disclosures, everything, and sort of tried to put it into a new category, which sort of combines mutual fund transparency with sophisticated investment techniques, which are possibly available for maybe in the alternate investment or the portfolio management space.
Okay. Raghav, thank you so much for joining us on the show this afternoon, explaining us this category, which is relatively new, but increasing in terms of the pace that we're seeing for interest. Thanks so much for joining in. But with that, we're absolutely out of time on this edition of MF Corner. Thank you so much for tuning in. Up next, we're closing that.